Hello, my friends. This is Doug Fabian. Welcome to my weekly ETF report. Today is Thursday, June 4th, 2015. As always, three things to talk about. Let's begin with the general equity markets around the world. And it's going to be a bit of a chartapalooza today. I've got three price charts I want to share with you, and all of them are indicating that global stocks, US, international, and emerging markets, are in a correction. To what degree is yet to be determined. Let's begin with a chart of VTI. VTI is one of those exchange traded funds that's in the top 20 ETFs by assets. It's a very simple product from Vanguard. It represents all stocks in the United States. As you can see from the chart of VTI here, we have been above and below the 50-day moving average, which I consider the short-term trend of the market, 4 times so far this year. And as of today, VTI is breaking down below the 50-day average for the 5th time so far this year. The progress on VTI year to date is just a plus 2%, and we're almost halfway through 2015. So it hasn't been a great year for U.S. equities. It has been a positive year, but you have to keep in the context that it is over 3 years since we've had more than a 10% correction in stocks. We had a 9% correction last year, and there has been evidence of a slowing economic growth in the U.S., a bit of a rise in long-term interest rates, and a worry about what the Fed is going to do next. So let's move overseas for a moment and take a look at a chart of EFA. Now, this is one of my favorite exchange traded funds so far this year, and if you've been a regular viewer of my weekly videos, you know I've favored international markets over U.S. markets for your equity allocations this year. EFA still up about 8% year to date, but it has also broken below its 50-day moving average, its short-term trend, for the first time this year. And then lastly, we have the emerging markets, the Vanguard VWO. This particular ETF not only has broken down below its 50-day average, but it broke below its 200-day average. And there's some nervousness about emerging markets around the world. Certainly China has still been strong, but countries that are export-oriented regarding commodities, like Brazil, have been very weak. And if the global economy is slowing, commodities are not going to find a new resurgence in price. So there's concerns about that. But VWO now back below its 200-day average, and that's kind of a big short-term negative. We'll put that in the negative camp. So markets are correcting, and you should expect corrections, and you should use corrections to your advantage. If you want to add money into the equity markets in any exchange-traded product, you want to do so on a correction. You don't want to be buying indexes at all-time highs if you can avoid it. This brings me to point number 2, and this is important, and I want you to study this next chart carefully. This is a chart of the Wisdom Tree India ETF. The ticker symbol is EPI. Now, this particular chart, you can see, has been correcting for the last couple of months, and it has now fallen about 12%. And this is the kind of investing opportunity that I really like. And here's some of the background. Here's some of the fundamentals regarding India. First of all, they're going through a lot of government reforms. Next, their GDP is expected to grow between 8 and 9% this year. The U.S. is barely going to do 2%. They are a big beneficiary of lower oil prices. They are lowering interest rates, and they're expected to have 20% stock market earnings growth this year. So I believe that this correction in India is a buying opportunity. And I will say EPI is one of the positions that we do own in successful ETF investing. And it's the kind of ETF that I believe offers good growth opportunity as we're moving forward. Lastly, I want to talk to you about a big headline that is being talked about in the financial press, and that's the huge run that we've had in Chinese stocks. And there's one camp that says China's in an ongoing bull market, it's all good. another camp that says China's a bubble, looking for a place to blow up, and it's really going to hurt investors. Well, I happen to fall into the bullish bull market camp. And I just got done writing the July issue of Successful ETF Investing. We have China allocations in our portfolios right now. But one of the things I wanted to let you know, and if you've been listening to my podcast and if you've been following my advice and commentary over the last 6 months, you know I've been talking about China a whole bunch, and I hope you have some China exposure. But what you may not know is that China is very underrepresented in global stock market indexes. Now, why is this important? Because index investing is so popular around the world. And in the month of June, the indexers, the companies that create these indexes, do rebalancing. And rumor has it that they're going to be allocating more money to China. China is the largest economy in the world. China's stocks are currently underrepresented in these indexes. It makes perfect sense to increase China's allocation to these global indices. Now, why is this important? Because if it happens, portfolio managers around the world are going to have to buy China stocks, and it's going to potentially be the catalyst for another leg up in China. So I wanted to share that news with you today. I found it quite interesting. I'll talk more about it on this week's podcast for Successful ETF Investing with Doug Fabian. So I hope you'll join me. And remember, you can send me your comments and questions to askdoug@dougfabian.com. Thanks so much for tuning in.